Your credit score affects any application you make for credit, from loans to mortgages to credit cards. But how exactly is your score worked out? We look at who decides your credit score and what you can do about it. Welcome back to Entrepreneurship 101. Today's we'll talk about the credit score and how it works. Before we start the video, please like, subscribe, and press the bell icon. What is a credit score? Separate credit reference agencies compile your credit score. A credit score is a number that represents the risk a borrower poses to a lender, or in other words, how likely that borrower is to repay a loan on time. In general, credit scores range from 300 to 850, with higher scores earning borrowers greater approval odds and more competitive rates. Types of personal credit scores. Generally speaking, two major credit scoring companies, FICO and VantageScore, each with its scoring models. Score ranges are the same for the most common models, but differences exist between the criteria considered in each calculation. Likewise, each scoring convention pulls information from different bureaus and imposes its minimum scoring requirements. For example, VantageScore was created by the three major credit bureaus, so each consumer has a single VantageScore. In contrast, FICO has bureau-specific scoring models that can vary depending on the information in a borrower's Experian, Equifax, and TransUnion report. The two major scoring models also treat new borrowers differently. To generate a score, FICO requires borrowers have an account that's 6 months or older plus activity on an account within the last 6 months. VantageScore can calculate a credit score as long as the consumer has at least one history, regardless of age. How credit scores work. Credit scores dictate whether someone is likely to qualify for everything from credit cards to car loans, mortgages, and apartment leases. Lenders also use a borrower's credit score to determine the interest rate and down payment it requires. Scores may even be used when opening new accounts with local utilities to evaluate the likelihood of a customer making on-time bill payments. FICO and VantageScore provide the most common scoring models based on information reported by the three main credit bureaus Experian, Equifax, and TransUnion. Each scoring model assigns weight to various factors that represent a borrower's creditworthiness, including payment history, outstanding balances, and length of credit. However, individual lenders may also calculate scores based on their proprietary algorithms. Credit score ranges. Industry-specific FICO scores range from 250 to 900, but FICO-based scores and VantageScore versions 3.0 and 4.0 each range from 300 to 850. A credit score of 700 or higher is generally considered good, while one that exceeds 800 is excellent. However, there are slight differences in how each scoring convention categorizes consumers. The most commonly used FICO score and VantageScore ranges are as follows. However, remember that what constitutes a good credit score can also depend on the lender and type of loan. To help you navigate these differences, many lenders offer a pre-qualification process that can predict approval odds and whether you're likely to get a competitive rate. How credit scores are calculated. Credit scores are calculated according to FICO and VantageScore's algorithms and based on information collected by the three major credit bureaus. These are the 5 factors that make up your FICO credit score. Payment history, 35%. Payment history is the most crucial factor in a consumer's credit score, accounting for 35% of the calculation. When evaluating a borrower's creditworthiness, scoring models look for late payments and then consider the lateness, number of tardy payments, and how long the late payments were made. While an isolated late price isn't likely to damage your credit score dramatically, it may still be impactful. On the other hand, demonstrating a pattern of late payments or making payments more than 60 days late is more harmful. Strengthen this portion of your credit score by creating consistent on-time payments and disputing any late charges that you believe are errors. Accounts owed 30%. Next to payment history. 30% of a consumer's FICO credit score is based on the total amount of outstanding debt or accounts a borrower has on their credit report. To evaluate this, scoring models look at the consumer's total debt, the number of accounts with balances, credit utilization ratios and types of accounts, like credit cards, mortgages, and student loans. You can bolster this component of your credit score by paying down credit balances and limiting future use of your cards. Likewise, stay on top of payments on installment loans, e.g. auto loans and mortgages, to keep your balances under control. Length of credit history 15%. A consumer's credit history length accounts for 15% of their credit score, making it the third most impactful factor. To evaluate the size of a borrower's credit history, the scoring models identify the average age of all accounts. the periods of the oldest and newest versions, the length of time each account has been open, and the date on which each statement was last active. For this reason, it's best not to close older versions in good standing, especially if you plan to apply for a mortgage or other large loan soon. Improving this aspect of your score typically requires time and patience. That said, becoming an authorized user on an older account in good standing may help you boost the age of your credit and improve your score. Credit mix 10%. A borrower's credit mix combines credit cards, loans, and other accounts. Scoring models reward borrowers for having various account types, though the factor only accounts for 10% of a credit score calculation. This includes revolving credit, like credit cards, and installments, such as personal loans and mortgages. Review your credit report and identify gaps in your credit mix to make the most of this factor. For example, opening a new credit card may be helpful if you don't have any revolving accounts on your credit report. Borrowers without installment loans can benefit from applying for a small personal loan and making regular, on-time payments. New credit 10%. When evaluating a borrower's overall creditworthiness, scoring models also look at recent inquiries or credit checks. This category, which only accounts for 10% of a consumer's credit score calculation, also includes how many new accounts are on the borrower's credit report and when they were opened. In general, borrowers who open multiple credit accounts simultaneously pose more risk to lenders, making them less attractive. So, while new credit isn't as impactful as other variables, limiting further inquiries on your report is still helpful if you're planning to apply for an auto loan or mortgage soon. That's all for today. Thanks for watching the video. If you enjoyed it, please comment, like, share, and subscribe to our channel for more exciting content.